Good morning. Today starts the beginning of our audio lectures for chapters 1, 2, and 3. I want you to keep in mind that as I advance through the slides, I will try to make it known which slide that I'm on. So I'll try to let you know if I'm on slide number 1, when I've advanced to slide number 2, so that way you can better keep up with the slides. I will say that you have the option of printing the slides if you so desire. If you do not want to print the slides, you're more than welcome to view them in DocSharing. They're going to be located under the Lecture Notes tab, and there you will be able to find all of the recorded lectures that you need for the class. I'll also try to make sure, or I'll try to embed the videos inside of the portal as well, but if not, you should be able to find them in DocSharing. Okay, so let's go ahead and get started with chapter 1. Chapter 1 is a basic chapter on healthcare finance. I'm into slide number 2. So the slide number 2 just pretty much lets you know that the first 2 chapters in the book just basically give the framework or the background information about why we're studying finance from a healthcare arena. Normally when we talk about finances, or you hear individuals talk about finances, they're usually in reference to something pertaining to a business, or we're talking about something in reference to a bank or some other financial institution. We get into credit unions, maybe automobile entities, things of that nature. Although that's the business side in its own arena, there is also a business side when it comes to healthcare, and when it comes to the financial piece or the financial side of healthcare. So just like it's important to keep retail businesses open, automobile businesses open, it's also important to keep physician offices up and running, as well as hospital units, facilities, or any other type of facility associated with the healthcare arena. Healthcare is a business, believe it or not. Healthcare is not just about the safety and the quality of care that we give to our individuals, but it's also about making sure that we keep our businesses up and running. Physicians have to be paid for the services that they provide. Those services are not free, not unless that physician or that entity or that facility choose to give those services free. However, those services have to be paid for. How they're paid for, that may come as a private payer for the individuals that see in the doctors. It may come from third-party payers such as our insurance companies, Medicare, Medicaid, Blue Cross, United Healthcare, Aetna. That's just to name a few. But those healthcare services have to be paid for. There is a process associated with those services. You've gone through now several of your classes prior to this class where you've had some exposure to what happens on the billing side when it comes to healthcare finance. You've been through classes that show you what happens on the insurance side when it comes to healthcare finance. So therefore, we have to make sure that we have, you have to make sure that the front end is operating as well as it should be, so that when you get on the back end, you get to the billing part, you get into the financial aspect, everything runs smoothly. Okay, so what do I mean by that? Well, you take the average patient that comes to the physician office that does not have insurance. Is that a problem? It can be, or it cannot be. Okay, the problem that you usually run into with individuals that go to the doctor's office and they don't have insurance, one of the main problems you run into is the fact that you try to figure out who's going to pay for these services. There are some patients that you come in contact with that are really good about paying their bills. You're not going to have an issue. But then there are some, they've not just come to your facility. They've been to 4 or 5 other facilities. And basically what they're doing is just running up a hospital bill or a medical office bill they have no intentions of paying for. So that responsibility lies with somebody. Not that that patient doesn't have some responsibility to it. Most of the time those patients might end up in collections. It goes on their credit report. But at the same time, physicians' offices usually have to end up eating some or mostly all of that cost. So when you have individuals that come to your facility and they don't have insurance, those facilities have to make sure they have some sort of a process in place as to how they're going to be able to recover their resources that they need for the services that they have provided. So in other words, how are we going to be paid for the services that we render to you today? Versus if you have someone that has insurance, worst case scenario, you can pretty much get your copay from that person, or the co-insurance, or the deductible, or whatever has to be paid up front. You can normally get that as usually guaranteed, because most places now don't even allow you to go and see the physician until the copayment, the co-insurance, deductible, whatever has been paid, or whatever has to be paid at the time of the visit. They normally collect that before they even allow that individual to go back and see the physician. So you know you have those monies. You also know that once the claim is submitted for that patient's visit that day, whatever the insurance allows, and we call that the allowance fee, whatever they allow to the physician, he or she is guaranteed to get that. Now, from there, if the patient hasn't paid a deductible, of course, you know that patient is subject to get a bill from you. You may or may not get those monies. And you know, you have some individuals say, hey, I paid my copay, I done this, I done that, I'm done. I'm not paying anything else. Yes, it is bad for them, but that healthcare facility reaps some of that as well. So that's basically what chapters 1 and 2 does. Chapter 1 pretty much focuses on more of the basic concepts of healthcare finance, just the very, very basic, whereas chapter 2 starts get into some of the healthcare insurance and some of the ways in which reimbursement is carried. Slide 3. So what is the primary goal of this course? Basically, what my goal is, my job is to make sure I help introduce to you principles and concepts behind healthcare finance. Now, all of you at this point should have taken 1 or 2 accounting courses. A lot of what you're going to see in the first 4 to 5 chapters of the book is a whole lot of your accounting principles resurfacing back. Okay, I would encourage you, as the instructor, to revisit your accounting books, especially your accounting 1 class. Go back and grab those basic accounting principles. It's not that you won't see them in this class, because you're going to. So I'm sure by now you remember balance statements, income statements, cash flows, depreciation, fixed costs, variable costs, total revenue, total margin, net income. All of those principles are going to resurface back into this course. Okay, that's pretty much what we're going to do in this particular course. You're going to have a lot of financial problems that you're going to be working every day, pretty much. And as you're working those problems, you're going to be able to see where you may need a little bit more of reinforcement on balancing statements or income statements or cash flow statements, and you'll be able to find out for yourself those things that you really need to revert back to your accounting principles book and resurface those concepts again. Slide 4. So what is the definition of healthcare finance? Basically, in a nutshell, healthcare finance is just like any other business, except now you get your mind geared onto how do I need to operate my healthcare facility, because just like any other business, healthcare facilities have expenses, they have costs, they have depreciation costs, they have fixed costs, they have variable costs. You have salaries, you have equipment, supplies, you have leasing, you have insurance. Healthcare finance facilities have the same, if not mostly all of the same type of costs associated with any other type of business. It's just that now it's more on this side where there's insurance involved, or there may not be insurance involved. Whereas with like a retail company, for example, Belk, JCPenney's, Macy's, those individuals rely on individuals, they rely on their customers to come and make purchases. And that's how they get reimbursed for the services they provide. In healthcare, we rely on individuals to have insurance, which is how physicians get reimbursed and we get reimbursed for services that we provide. Okay? Slide number 5, accounting versus financial management. So, accounting basically deals with the financial dollar amounts or financial terms. However you want to look at it, that's what accounting deals with. So accounting is the number side of it. Basically, my debits, my credits, my net incomes, my revenues, my expenses. I'm actually looking at the numbers. Whereas with the financial management, this is how I make my financial decisions. My financial decisions are based off of the numbers that I see. I'm better able to make theories. I'm better able to make financial decisions. Do I pay this out? Do I not pay this out? Is this necessary? Is this not necessary? How do I cut costs? Do I need to cut some salaries? Okay, if I cut salaries, do I have the manpower to keep myself running up and running? Is it possible for me to eliminate some positions and cross train rather in other positions so that I can help to recover some of the expense? Am I giving bonuses every year? Do I need to cut that out? Am I allowing overtime? Do I need to cut that out? That's the financial management piece of healthcare finance. So it's like once you get done looking at numbers, and I think that's what managers don't understand. Yes, you can look at numbers all day long, put them in a spreadsheet, however you want to do it. But at the end of the day, there are decisions that have to be made because the goal is to operate effectively and efficiently. That is the goal. That should be a manager's goal every day. I want to operate my facility effectively and efficiently. You never want to start at a zero amount every month. You don't want to end up in a zero amount at the end of every month, or at the end of every 6 months, or at the end of every fiscal year. You always want to see progress in that you're doing. You always want to. You've got to know as a manager when you have overspent. You've got to know as a manager when you have made not so good of a decision. And you also need to know when you've made some really good decisions. Or you also got to know when you've made some pretty good decisions. You kind of like in the median. Okay? So you have to know how to drift and shift your finances so that your business can stay up and going. Okay? Slide number 6. So what is the definition of a business? Businesses have several different characteristics, as you can see in the slide. Basically, business is where individuals come and they buy assets as far as goods and services, but it takes funds to do that. Okay? A business is not just where you sell funds, but a business is also where you buy funds and things that you need. Okay, so the role of finance. Well, finance has different type of activities. I'm on slide number 7. Some of the things that you do in financing, you've heard these terms before: planning and budgeting. That's something that managers really have to get used to. I usually tell my students, hey, the way you plan and you budget in your household is different when you're in a management role in healthcare. Why is it different? Because you are expecting more costs. You are expecting more decisions to be made. You're expecting more expenses to be paid out. It's just so much different. Somewhat of the, you kind of think in the same way when it comes to planning and budgeting, but you have a lot more that you have to plan and budget for when you're the manager over a facility versus if you're just the sole person of the finances at your home. So it's a little bit different. In financing, there is financial reporting. There is financing decisions. You have to think about investments. You have to think about making, investments into maybe investing into other corporations where you all can become as one. A lot of times you have to think about investing into other entities. So you have to think about financial risk as well. Okay? Do managers take financial risk while they're operating their business? Well, of course. That's within the business. Most businesses take a financial risk. A lot of times you can invest your money in something, or you can go and make a purchase on something, and you really don't know how it's going to turn out at the time, but you take a risk. Okay? We take risk every day. You take a risk every day, even with individuals that don't have insurance, and even with individuals that have insurance. You take a risk pretty much all the time. Slide number 8. So what are the 4 C's of finances? Okay, they're listed here on the slide for you: cost, cash, capital, and control. Now, you got to learn how to minimize cost. If it don't have to be spent, don't spend it. If you can curb the cost, curb it. If you can be frugal, be frugal. Okay? Cash sufficiency. Always operate and know that if something major happened, you have a resource that you can go to. Okay? You don't want to always be borrowing. Be in business to make money. Be in business to make money. Provide quality service, but know when and how to control your cost. Capital access, controlling your financial resources. Slide number 9. So how is the finance department structured? Do you just pull somebody off the street and say, hey, I'm going to put you in my finance office? No. Do you pull the person from the mail room, put them in the finance office? No. Do you pull the person from the front desk, put them in the finance office? No. A finance office needs to be run by financially minded individuals. Okay? Most finance offices or finance departments, and this is usually what you see in hospitals. Usually you see this in large hospitals, because most doctors' offices, the manager kind of looks and reviews the books, but a lot of them are usually contract their financial or their billing side out to a third-party contractor. But in hospitals, they actually have individuals inside of the hospitals who help operate the finances. We call those people the CFOs, or the Chief Financial Officers. The CFOs or the Chief Financial Officers. Sometimes you may hear them being referred to as the VP of Finance, and VP, Vice President. Usually under this department or under this particular individuals, there may be a comptroller and a treasurer. So the comptroller is the person that's responsible for the budgeting, and they report the different financial activities. They're usually managing the payables and the receivables. So you hear accounts payable, accounts receivable. And then you have the treasurer. Pretty much that's the person that works side by side of the comptroller. They help with debt management and financial risk management. Okay? In a small medical practice, the question says, what about a small medical practice? In a small medical practice, like I said, you normally have the manager that kind of oversees the finances. They may have coders, a couple of coders that may work back there and make sure the claims and everything gets sent through. But for the most part, they may usually just contract themselves out with a third-party payer. There are different types, slide number 10, there are different types of health services settings. Some of those things, or some of those settings rather, includes like hospitals, ambulatory care. And if you remember from taking Intro to Healthcare Services, then most hospital care is usually for inpatients. Outpatient care is usually what we call ambulatory. Another name for that being ambulatory care. You know, you have long-term care. You got your baby boomers. They're getting older. They require more long-term care. And then, of course, you have integrated delivery systems. Slide number 11. Current management challenges. According to ACHE, there are some management challenges. Financial concerns is always going to be one management concern within the finance arena. And of course, we're going to always have Medicare, Medicaid issues. But then you get into bad debt losses. Okay, that may come with managers making some poor decisions, corporate making some poor decisions. It could come from services not being paid for that you have rendered unto patients. So all of those are classified as current management challenges. Slide number 12. So what are the three major types of or major categories of businesses, organizations? You have the proprietorships, partnerships, and corporations. Okay. So a lot of physician offices usually like to be partnered with each other. A lot of them. One reason they like that is because it helps them to be able to share the cost amongst each other. When you're in a facility by yourself, a lot of times you look at, doctors look at, I got everything coming to me, it's my practice, and this and etc. But, I don't think a lot of times they sit back and really count the cost of what it means to actually operate in a facility by yourself. So what is a proprietorship? Okay, so proprietorships are pretty much business owned by single individuals. Okay, those are individuals that are in business by themselves. It's easy to do, but it's a lot of work behind it. Easy to do, but it's a lot of work behind it. But these are businesses that are usually owned by one individual. Okay? Partnerships are usually those entities that are owned by two or more individuals. Okay? Partnerships are usually businesses that are owned by two or more individuals. Okay, and then corporations. Corporations are usually two or more businesses that have combined together. And basically, they're combining together. They've become just such a big corporation. Okay, so let me kind of give you a little bit of an example. Let's look at UAB, for example. UAB is what we classify as huge corporation. So when we look at Children's Hospital, or we look at UAB Medical West, when we look at those hospitals, we don't necessarily look at them as being proprietors or partnerships. We really look at them as being like corporate, like corporate facilities, because they all pretty much within the realm of each other. And that's usually how we look at those corporations when we look at them. We look at UAB and we look at all of the different types of facilities that are in and around UAB. Like, for example, the Spain Rehab Center. When you look at Spain Rehab Center, yes, that's a hospital facility off to itself, but at the same time, they're incorporated with UAB. When you look at the Burn Center, yes, that's a center off to itself, but it's incorporated within UAB. Okay, so I hope that makes sense to you as far as the difference in the different types of major categories of businesses, organizations. Okay, so let's look at now slide number 13. So what are some advantages and disadvantages of being individually owned versus being with another individual or two more individuals? One of the advantages of being either or is the ease of formation and then the regulations. You're not subject to as many regulations when you have that. However, the disadvantages of that is the unlimited liability that's associated with that, with being proprietors and partnerships. There is liability associated with it, but how much, that's where it gets kind of sticky. Slide number 14. What's the advantages or disadvantages of being in a corporation? So when you're in a corporation, it's much more easier with raising capital, and it's because you're huge, you're large, you can do that. It's easy to transfer ownership when you're in a corporation. However, taxation may double or triple when you are investor owned and you're inside of when you're an investor owned corporation, your taxes could double or triple. And that's one of the disadvantages of being in a corporation. Slide number 15 just talks about some of the different hybrid forms of organization: LLPs, LLCs, professional corporations, and associations. So I ask that when you go through your textbook and you're looking at those different hybrid forms, make sure you take note of the distinction between all of these that you see listed up here, between all four of them. These are known as the hybrid forms of organizations. Slide number 16 talks about forms of ownership. Okay, most ownership is investor owned, which means that someone invested actually into the business itself. And a lot of times when you invest into a business, you look to make profit off of that business. So most of the organizations that you see within healthcare is due to the fact that someone invested into that. It's just like when you have a piece of abandoned property, or let's say, for instance, you have a hospital that filed bankrupt, had to shut doors, or whatever the case may be. Sometimes you have individuals that are willing to invest into that organization to bring it back up to, par or whatever. And so we call those businesses investor-owned businesses. Slide number 17. One of the type of group of individuals that we say have an interest in investor-owned incorporation, we call these individuals stockholders. Okay? We call these individuals stockholders. Stockholders usually have rights of control. They are more concerned about their return on investment. So if you remember from healthcare economics, the return on investment, they're looking at, based on what they invest into a company, depending on how much they invested, they look back for a nice size return on that particular investment. So, it's just like anything that you do on a personal level. When you invest into something, you look for that to come. You look for that return on investment back on that. It's just like a person that goes and buy houses and they fix these houses up, turn around and resell these houses or rent these houses out. At the end of the year, they look to gain pretty sizable amount of it. It's like a huge investment for them. A lot of times you may take a loan out for those kind of things, but once you pay that loan off, you still have those housing stuff. That's truly an investment for you. So when you hear people say, "Oh, I just bought 4 or 5 properties because it's a really good investment for me," that's what they do. They invest into those properties, resell those properties, lend those properties out to get the highest return on investment back that they can get. One thing about investing on corporations, though, that you have to keep in mind, they are subject to all 3 taxes: property, income, sales. Property, income, sales. Slide number 18, not-for-profit corporations. I know that this is familiar. You're familiar with this from previous classes. Just remember that not-for-profit generally don't have any shareholders. These corporations are usually exempt from all three taxes: property, income, and sales. Slide number 19, organizational goals. So the primary goal of an investor-owned corporation is maximization. I'm investing into this company, I'm investing into this business, and I'm looking for ways to maximize my profits. I'm looking for ways to maximize my wealth. I'm looking for ways to increase my resources. Okay, let's look over to slide number 22. Let's go over to slide number 22. The primary financial goal of investor-owned corporation. The primary financial goal of investor-owned corporation stems from maximization. Again, I want to stress that. Investor-owned corporations are consistently looking at ways that they can maximize their finances. Whereas the goal of a not-for-profit corporation, they just want to be able to ensure the viability of their organization. They're trying to do everything they can to stay up and running. That's what they're looking at, trying to figure out ways that they can just stay up and running. When you have investor-owned corporation, somebody's already invested into them, and they're just looking for ways to maximize on their resources, and they're looking at their return on investment. Well, with your other corporations, how can we stay in business? What will it take for us to stay in business? Okay. Slide number 23, the Affordable Care Act. I know that you've heard that before. You're very familiar with the Affordable Care Act. We know that changes occur with that act all the time. That Affordable Care Act affects all of us in healthcare. Okay? It affects how your business operates daily. And the reason it affects it so is because it affects the access of insurance. And with access of insurance comes the access of health care. Okay, so it affects all those different things. You take the average person now, where premiums are now with the Affordable Care Act, what would happen to those individuals if the premiums were raised? Would those same individuals afford to have that insurance? Well, we don't know that. They may or may not be able to. We're not sure. But one thing you can be sure, excuse me, one thing you can be sure is that providers will have to change as the environment change. So as the economy change, as the environment change, physicians will have to change the way they operate their practices. They will. If they intend to stay in business, they will have to change the way they operate their practices. Okay? Slide number 24. So how is this course going to be organized? Well, basically, the way we're going to do with the organization of the course, you're going to start out with basic concepts of the course. You're going to start out with that first. Basic concepts. Learn up front about the different types of insurances and how insurances reimburse providers for their services. That's like the very first thing that you'll learn. Then we're going to start getting into the very basics of the financial accounting piece. Start talking about income statements, balancing statements, statement of cash flows. We'll kind of start with that next, after we kind of get you through managerial accounting, basic financial concepts. Then we're going to get a little bit into long-term financing. And then we're going to talk a little bit about making investments. We're going to talk a little bit about break even. I don't know if you remember that from accounting, but we're going to talk a little bit about breaking even, and we're going to talk a little bit more about how you estimate cash flows monthly. And then just some other things that we're going to talk about. Slide number 27, we're going to talk a little bit about revenue cycles, leasing, business business financing. We're going to talk about some short-term financing. And that's something that I really want you to have a good understanding of, is the difference between long-term and short-term financing. So we're going to talk a little bit about that as well. Okay? So this pretty much concludes the notes for chapter 1. Even though all of the concepts were not discussed in this particular lecture, students are still responsible for the material in the text. So just make sure that you read back through chapter 1 so that you can have a better understanding of all of the concepts. Thank you very much, and if you have any questions, you're more than welcome to reach out to me.